Good evening, students. Welcome to Tybcom Same 5 Financial Accounts Last Day Revision lecture. Today I'll be taking revision of internal reconstruction, investments, and buyback. Okay, so we'll start with internal reconstruction first. So those students who want complete revision, I'll just give a brief about this chapter. Well, internal reconstruction deals with the companies which are suffering from losses. So there may be a new product or there may be some hope uh, for the company to recover or take a U-turn from suffering from losses. So they do some adjustments or understanding or MOUs with the different parties in the company, and they try to rebuild themselves. So that's about the internal reconstruction. Now, how to identify a sum, whether it's a internal reconstruction sum, then we can uh, read the last line or last para. In that, they will mention that prepare balance sheet after reconstruction, or sometimes the lines may be there in the first para itself that the scheme was approved by the court and such other things. Okay. So in the question, you will be given a balance sheet and adjustments, and they may ask you to prepare or pass journal entries, prepare capital reduction account and balance sheet after the reconstruction is carried out. Okay. So the most important account in this chapter is capital reduction account. I'll just give some important tips now before starting with the sum. So most important account in this chapter is capital reduction account. Okay. Now, in the transactions or other in adjustments, they will tell you that this liability was reduced or this assets value was reduced, this assets value was increased. Okay. So in all the entries of profit and loss, we used to use P&L account. But in internal reconstruction chapter or settings, what we have to use is capital reduction account instead of using P&L account. Okay, say for example, if value of asset increased, then there is a profit. So capital reduction account will be credited instead of P&L account. Okay, I'll tell you. Suppose asset is there, okay, and its value increased. So it's a profit, right? Same way, if there is a liability and its value decreased, in that case also there is a profit, right? In such cases, in the journal entry, the capital reduction account will be credited. Okay. So similar to P&L account, we will be using capital reduction account to record profit or losses. Okay. So same way in case of asset, if value reduced, then there will be a loss. So capital reduction account will be debited. In case of liability, suppose liability increased, then there will be a loss. So capital reduction account will be debited. Okay. So this is the main part or main account you should be taking care of. Okay. Capital reduction account. Okay. So let us start. We'll read the balance sheet first. We are given authorized capital. Whenever authorized capital is given, you may refer it for the face value or number of shares. But let me tell you, this authorized capital is never considered in the sum. Okay. Even if you check the totals, the authorized capital is not considered. It's just a nominal capital. This is the maximum limit of shares which a company can issue. So in the sum, ignore this part, authorized capital. Okay. After that, we are given subscribed and paid up capital. Details are 20,000 equity shares of rupees 10 each, fully paid. So equity share detail is given. Company already has 20,000 equity shares of 10 each. So this way, giving a total of 2 lakh rupees. And after that, we are given 18,000 7% preference shares of 10 is fully paid. Okay, so 1,80,000 rupees. So this is capital. Then under reserves, we are given workmen compensation fund. Okay, so this company is having, I think, two offices at Pune and Bombay. So this workmen compensation fund is nothing but a reserve unless some liability arises. Okay, so workmen compensation fund is a reserve unless and until some liability arises. Say, for example, in Pune branch or Pune office has a workman compensation fund of 20,000, and if there is a liability of 5,000, okay, then 5,000 will be converted into current liability, and rest will be used as reserves. Okay. Next, secured loans, 6% A debentures uh, secured on Pune properties. Okay, and 6% B debentures secured on Bombay properties. Then we are given current liabilities and provisions. Under that, we have only one item, sundry creditors. Okay. On asset side, we have fixed assets, Pune property, Bombay property, plant and machinery. Investments are given. Okay, investment consists of investment in relation to the workmen compensation fund. See, whenever we have workmen compensation fund, what company has to do is it has to invest the same amount outside the company so as to secure the reserve. Okay. So company has kept aside 30,000 for both of these plants. Okay, and equal amount, that is 30,000, is invested somewhere. Rather, it's invested in 6% government loan. Clear? Okay. Then miscellaneous expenses and losses are given in that P&L is there, 40,000. So this indicates loss. P&L account on the asset side indicates a loss. Okay. So we have read the balance sheet. Now let us read the adjustments. Following scheme, I told you this word will be there, scheme. Following scheme of reconstruction was duly approved by court. First, equity shares were to be reduced to one each. As I told you, this company is trying stakeholders, okay, to sacrifice some amount. Okay, the real owners of the company are equity shareholders, so they will be doing maximum sacrifice. Okay, see how much was the equity capital? You can see there were 20,000 equity shares of 10 each, so they had contributed 2 lakh rupees. Okay, now look at the first adjustment. What it says: equity shares were to be reduced to one each. It means their value of 10 rupees share will be considered as rupee 1. So they are sacrificing 9 rupees. Okay. For company, share capital is a liability. So now liability reduced. So company has made a profit, isn't it? So capital reduction account will be credited. Are you getting this, students? Okay. So we can pass entry for this. Right, number 1. Whenever equity share or preference shares, their value is reduced, we have to debit them. See, by default, all the liabilities have credit balance and all the assets have debit balance. Okay. So liabilities have credit balance and assets have debit balance. Okay. So while reversing them, we have to reverse them in the journal entry. Okay. So if credit item is there, if we have to reduce it, we have to debit. Okay. On the asset side, we have so many assets, or they mostly have debit balance. So in order to reduce them, we have to credit them. Okay. Now, first entry, as I read, equity shares were to be reduced to rupees 1 each. So we consider that the face value is not changed, but paid up value is reduced to 1 rupee. Okay, we presume that. Since nothing concrete is mentioned, so I'll write the entry. Equity shares are credits, so we'll debit them. Okay, so it will be equity share capital account debit. To capital reduction account. We have to account for the difference. Okay, so per share 9 rupees is the gain made by the company. On how many shares? On 20,000 shares. Okay, so 20,000 into 9. Okay, so 1,80,000 is the profit made by the company on reduction of equity share value from 10 to 1. Okay, we presume that face value isn't changed because for that you need to change authorized capital also, and nothing such information is given. So we presume that the paid up value of one share is reduced from 10 to 1 rupees. So 9 rupees is the profit made by the company. Okay, clear? So many students get confused whether to consider it as change in face value or not. Okay, so you need not do that. Company, if they change the face value, they will have to again uh, give away a new share certificates and all. So better assumption will be that the paid up value is changed. Okay, so this will save them from lot of procedures. Okay, I will not show the narration. You can write very well narration. Okay, I'll go to next one. Preference shares were to be reduced by rupees 2. See, look here. In earlier statement, it was equity shares reduced to rupees 1. It suggests that the new value is rupees 1. Okay. Now here they are saying reduced by rupees 2 per share. So profit is only 2 per share in case of preference shares. Okay. I hope you can read it. Okay. Properly. Now preferences, number of preferences were 18,000, and per share we are earning or we are gaining 2 rupees. Okay. So first debit the liability. Okay, liability is reduced. All right, 7% preference share capital account debit. To capital reduction account. Okay, on 18,000, 2 rupees per share. Okay, so 36,000 is our profit. We'll go to next one. Debenture holders were to forego their unpaid interest, rupees 5,200, which is included in sundry creditors. Okay, when they say something is included in some other item, just consider that some other item will be here. Although debenture interest is outstanding, but it is included in creditors. So whenever we have to pass entry, we'll consider only creditors. Okay, clear? Now, tell me. Look here, debenture holders have a right to receive interest. Okay, so 5,200, which was their right to receive interest, they are ready to forego this. So for company, it's a gain, isn't it? So again, capital reduction will be credited, and this creditor always has credit balance, so will be now debited in order to reduce its value. Okay, so I'll write creditors account debit to capital reduction account. Always remember, whenever loss is there, capital reduction account will be debited and the relevant account will be credited. In case company is gaining, there is a profit, capital reduction will be credited and the other item will be debited. Okay. Now, how much is the profit on account of debenture interest? 5,200. Clear, students? Okay. Next, fourth adjustment. Just a minute, I'll just give this to the right side. Okay. Fourth one. B debenture holders agreed to take over the Bombay property at 50,000 and paid the balance amount due from them in cash. Okay. So here two things are there. Debenture holders agreed to take over Bombay property at 50,000. So let us see Bombay property. What is the value of Bombay property? 1,20,000. Okay. And paid the balance amount due from them in cash. So what is the value of debentures? B debentures of Bombay property Just a minute. The value given. BTM should target to take over the Bombay property at 50,000 only. The value of Bombay property is 1,20,000. They are taking over at only 50,000. Okay. So take on over at only 50,000. Okay. So this is of no use now. Okay. Then what is their liability? Bombay property value liability debentures is 35,000. Okay. So debenture holders value outstanding value is 35,000. Okay. Understand again. There was Bombay property. Okay. In the asset side, on the asset side, its worth was 1,20,000. Okay. It is taken over at how much value? 50,000. So there is a loss of 70,000 first of all. There is a loss of 70. Okay. Now this is taken against a liability of 35,000. Okay. And the balance they said that it will be paid by the by debenture holders to the company in cash. So how much cash company will receive? 15,000. Okay, students. I'll just explain it once again. There is a property, Bombay property of 1,20,000. Okay. Now it is taken over by the debenture holders at 50,000. So there is a loss of 70,000. Okay. Then it is taken over at 50,000. Their liability was only 35,000. So remaining 15,000 they will pay in cash. Okay. So what I suggest students, first uh, pass entry for revaluation. There is a loss of 70,000 on account of this Bombay property. First record that loss. Okay. So whenever loss is there, what you will do? Capital reduction account will be debited. Okay. To Bombay property. Okay, how much is the loss? 70,000. You understood now? First, we accounted for the loss. Okay. Now the value is reduced from 120 to 50. Clear? Now its value is 50,000. Okay. Now what has happened? They are taking over this 50,000 worth asset. Okay. And they are paying us cash 15,000. So I'll write cash and bank account debit. How much we are receiving? 15,000. Debentures always has credit balance. Now we are cancelling them out. So they will be debited. Okay. B debentures account debit. Their value was 35,000. Against this, what is going out? Credit note goes out to Bombay property. Its value as of now is only 50,000. Clear? I hope this is clear, students. Okay, we'll move ahead. Workmen's Compensation Fund, Bombay, disclosed the fact that actually there was a liability of rupees 2,000 only. Okay, now let us refer to balance sheet. Workmen Compensation Fund of Bombay is 10,000. Okay, I'll write here. Workmen Compensation Fund is only 10,000 was given in the balance. That's 10,000. There is a liability of only 2,000. Okay. We suggest that the balance amount is available to be transferred to capital reduction account. Okay. We can use that balance. Okay. For the purpose of reconstruction. Okay. So 8,000 we can transfer to capital reduction. Okay. Let us read further. As a result, the relevant fund account balance was to be brought down to the required amount. investments were realized at 10% above the book values. Okay. See, as I told you, to every workman compensation fund, they will have a corresponding investment. You can look on the asset side, 6% government loan is there, 30,000. So its bifurcation must be 20,000 towards Pune Workman Compensation Fund and 10,000 towards Bombay Workman Compensation Fund. Okay. So now that investment which belongs to Bombay Workman Compensation Fund is being sold at 10% profit. Okay. So investment was worth 10,000. It is sold, but will not sell everything. Out of this, still balance is there in liability worth rupees 2,000. So available for sale is only 8,000. So we'll sell investment worth rupees 8,000, and we are gaining a profit here of 10%. So it will be 800, right? So you will receive in bank how much? 8,800. Okay. I'll explain this again. Workman Compensation Fund, Bombay, disclosed the fact that actually there was a liability of 2,000 only. Okay. So, see, I wrote here, Workman Compensation Fund is 10,000, liability is only 2,000. So, we can use this 8,000 for capital reduction purpose. Okay. Okay. Then they told us as a result, the relevant fund balance was to be brought down to the required amount. So, we'll reduce it to 2,000 only, they said. Okay. Don't keep above that. Investments were realized at 10% above the book value. So as I told you, equal amount must be invested somewhere else. Okay, so 10,000 investment must be belonging to this fund, Bombay fund. Okay, out of that we have to keep aside 2,000 because a liability is there. So 8,000 we can sell off in the markets, and which is actually sold, and we have earned a profit of 800. Okay, so I'll pass entry for this sale. Bank account debit. How much we are receiving? 8,800, right? So that investment is going out. Okay, to 6% government loan. It was worth 8,000. Okay, so balance profit is 800. Always remember, when there is a earmarked investment, that is investment for any particular fund, then the profit made on that sale of investment will go to that fund account. Okay, remember this. So this 800 won't go to P&L. Remember this. To that workman compensation. We had a balance of 10,000 already. Okay. Now it will become, I'll just add it here, due to profit. Okay, this will increase by 800. So in all, we'll have 10,800 in workman compensation fund. Out of that, how much is the liability? 2,000. So remaining 8,800 we can transfer to capital reduction account. Understood, students? I'll write here number 7. Whenever you are transferring funds, okay, from one fund to the other, the fund from where you are transferring will be debited, and the fund to which you are transferring, in any entry, it will be credited. Okay, so we are transferring from Workman Compensation Fund. So I'll debit Workman Compensation Fund, Bombay, to capital reduction account. Okay, 8,800. I hope this is clear, students. Okay, we'll go to next one. The plant and machinery were to be written down by 90,000. So asset reduced. So there is a loss. Okay. All right. In fact, there will be many adjustments in which loss will be there. Okay, so we can pass a combined entry for those. This will save your time. So in all the losses entry, capital reduction account will be debited. Capital reduction account will be debited. Two, we can one by one write all the assets on which we are incurring losses. The first one they told is plant and machinery account. So plant and machinery account. How much is the loss on plant and machinery? 90,000. 90,000. See, in every sum on the asset side, balance sheet asset side, there will be some items which are fictitious or bogus, which doesn't actually reflect as an asset. See P&L account on the asset side under miscellaneous head. Okay, although it's there on the asset side, it is not an asset; it's a loss. So we can write off that now. Okay, we'll combine the entries to P&L account. 40,000. Okay, so total is 1,30,000 here. Okay, we go to next one. Any balance remaining was to be applied as to 75% in writing down the Pune property and 25% transferred to capital reserve. Okay, we'll do that later on. Last past entries. Okay, so we are done, I think, with all the entries. Now we have to see how much balance is there in capital reduction account. Out of that, 75% will write off Pune property and 25% will transfer to capital reserve. Okay, now how to count how much balance is there. Okay, what we have to do, wherever capital reduction is credited, we have to add. Okay, and wherever it's the on debit side, we have to subtract or minus it to get the balance. Okay, so I'll do it here. Let me see on credit side how many figures are there. On how many occasions it is credited. First entry 180, 180,000 plus second entry again credit 36,000. Third entry again credit 5,200. In this chapter, there is no special order or specific order which you have to follow. Okay. Then in fourth entry, it is minus. Next entry, nothing is there. No loss, no gain. Sixth entry, there is no profit loss. In seventh entry, there is a profit of 8,800. So 8,800. There is a loss of 130. So 1 minus 130. Okay, we see the sum of 75 to 25. Okay, understood how I got this value? Wait, I'll put a asterisk so you can see everything. All credit added and debit subtracted. Okay, so I'm getting a balance of 30,000. So I'm getting a balance of 30,000 rupees. Now they have told me that out of the 30,000, put 75% to write off Pune property and 25 transfer to capital reserve. So I'll do that. I'll pass entry here. I have to utilize capital reduction account, right? So it will be debited. Ninth entry. Capital reduction account debit. $30,000 was balance to Pune property. How much? 75%. So 30,000 into 0.75 and transfer to capital reserve the balance amount, not 25%. So 30,000 into 0.25. Okay, students. So I hope this was clear. Okay. Now they may even ask you to prepare capital reduction account. So very simple way of making an account. I'll show you in brief 5 minutes only. Quick time I'll show you how to build account. Or I think you must be knowing it. So we build it 2 minutes. I'll just show you. You can shift the working notes on this side. So this is capital reduction account. We'll have particulars, amount, particulars, amount. Okay. This is debit side and this is credit side, right? Okay. So normal posting you have learned in FYGC. Okay. So first entry, equity share capital account debit to capital reduction. So in capital it will be by equity share capital. You write by equity share capital. Okay. Amount 1,80,000. Okay. Again by 7% preference share capital account. So this way you have to post all the entries. 36 now. Again by creditors 5,200. Okay. I hope this is clear, students. Always remember the main thing is that you should understand when capital reduction account is to be debited in an entry or credited. Okay. So whenever there is a loss, capital reduction will be debited, and that item which is causing the loss will be credited. Okay. If some profit entry is given, capital reduction will go to credit, and that item will go to debit. Okay. Okay, students. So this way you can complete the ledger account. Okay. Since we have already dealt with the balance 30,000, so this account will tally. Okay. You can get the balancing figure in this account. Okay. And then you can transfer 75 and 25. Even that is okay. Okay. Now in the sum you may be asked to make a balance sheet. Okay. So I won't be revising your final accounts here. Okay. So you must have done that final account. So in that final account format, you can show it. If you don't know new final account formats, you stick to this format only. But do make balance sheet. Okay. So now we'll go to investment accounts, investment accounting. Give me 2 minutes. Give me 2 minutes. Okay. In between, I'll give you some short notes or theory questions. I'll give some questions, theory questions. Should I dictate, students? You'll be writing it down. Okay. First one is One short note is there. Uh, Write short note on internal reconstruction of companies. Internal reconstruction of companies. Second short note, consolidation and subdivision of shares. Next, methods of internal reconstruction. Need for reconstruction of company. And last one on this chapter, difference between internal and external reconstruction of companies. Okay. Uh, Next is buyback of shares. Buyback of shares. Write short notes on sources of buyback of equity shares. Sources of buyback of equity shares. Next, benefits of buyback. Third, conditions for buyback of shares. Okay. Now investment accounting. Investment accounting theory questions. Write short notes on right shares and bonus shares. X in second one, X interest and cum interest transactions. Next, explain pre-acquisition and post-acquisition dividend in personal investment accounting. Next, sale of right entitlement. Sale of right entitlement and purchase of right shares. Now, chapter number 5. Write short notes on factors affecting ethical behavior. Write short notes on factors affecting ethical behavior. Next, meaning, scope, and features of ethics. Meaning, scope, and features of ethics. Next question. What is ethical behavior? Explain the principles of accounting ethics. Explain the principles of accounting ethics. Next, explain meaning and types of whistleblowing. Explain meaning and type of whistleblowing. Number two, explain laws and ethics. Okay. In case of final accounts, normally they will be asking all the schedules, okay, and different heads which are there in balance sheet and income statement. Okay. So that you must be well aware. Okay. But in the final accounts, let me tell you a couple of things which you should read thoroughly, like contingent liability, purchase methods of purchase consideration, bifurcation of fixed assets, okay, that's it, students. Okay, now I'll read out a few question bank. One more question bank I have got for FA. So I'll just read out whichever I have already given. Don't write it again. Okay. Apart from that, if you if I tell any other question, just write it down. Methods of internal given, contingent liability given. What do you mean by ethics already given? Factors affecting ethical behavior. Write down these factors affecting ethical behavior. Distinguish internal external given. Ex interest, non interest given. Conditions given. What is ethical given? Discuss, explain the concept of ethics with reference to corporate ethics. Okay. Outstanding and prepaid expenses. Rule of whistleblowing done. Objectives of ethics done. Buyback of shares and its benefits. Okay. Pre-acquisition, post-acquisition already given. P&L format. Okay. You all know that. This one is new. Fixed and variable income investments. Fixed and variable income investments. Then disclosure of non-current investments in a company. Okay, one more is there. CSR, corporate social responsibility. That's it. This will be enough for theory. So I suggest you have a glance at these notes. Okay, short notes. Okay, don't leave this question, theory question. Do attempt it in full. Okay. Okay. So now we'll go to investment accounting. Give me a minute. I'll be solving two sums, one on debenture and second one on shares, in which right shares, bonus shares will be there. Okay. So two sums I'll be solving. I'll just copy the format of journal entries. Give me a minute. Okay. Let me copy the format of journal entries. Oh. I think we need a ledger rather than journal. Wait. I'll have to draw it. In buyback, we need those, not in investment. Okay. So I have to make one ledger account. Let us read the sum. A finance company limited holds as on 1st April 2021 rupees 1,20,000 cost, rupees 117,600, 6% gold bonds as investment on which interest is payable half yearly on 1st Jan and 1st July. So it is in the books of finance company. I'll write in the book of okay. Then your ledger account will be date. Okay. Name of the account first I'll write 6% gold bond. Investment in 6% gold bond account. Okay. In our ledger, we'll have columns like date, particulars. I'll adjust the size in 2 minutes. Particulars. I'm not drawing the journal for you. First, I need face value, then interest, then cost column. Okay. Then on credit side, 10 columns I need. Okay, so we have ledger account now. In the books of a finance company, investment in 6% gold bond account. So this way, from the question itself, you can derive the account name. Okay. What I suggest, whenever you have paper, okay, if the transactions are jumbled up, you can put them in an order. Okay. So let me show you how you can do it. Uh, First, we'll read the sum. Okay, so there was a balance on 1st April. So your the company is following financial year, starting on 1st April and will end on 31st March 2020. Okay, so opening balance is given. Then we are told some transaction about purchase and sale. So after opening, first transaction will be of purchase 1st August. Okay, then after that sale will be there 1st November. Then on 1st December, okay, in between we have to adjust 2 more entries, which are those entries of interest. Okay, in the second line we were told that interest is paid on 1st January and 1st July. Okay, so we can make a timeline if you want, like first opening, then purchase is there on 1st August. So opening is on April. Okay, first, then purchase transaction is there on 1st August. After that, before that July will come, so interest will come here. On 1st July we are getting interest. So 1st July we are getting interest. Then purchase is there on 1st August. Then on 1st November a sale is there. So this we have to arrange all the transactions so that you don't miss any entry. Okay. So after 1st November, First December purchase is there again. Purchase first December. Then next, so after first December we have first January interest rate. So interest first January. Then after January we have on first February sale is there. Okay. So sale is there on first February. Okay. We can count opening plus 4 transaction, 5 plus 2, 7. 1, 2, 3, 4, 5, 6, 7. Yes, we have considered all the transactions. This timeline is important. On computer, I can't make it properly, but with the paper and pen or pencil, you can draw it below your ledger account and put it in correct order. Okay. So this way you won't miss any transaction. Okay. So let me tell you about investment. Investment is an asset, so it will have opening balance on the debit side. So on 1st April, you will be writing like date first April 2021. It will be to balance brought down. In case of investment is made in a debenture or any asset, any investment asset, which is giving a fixed return like 6%, 8% debentures. Okay. Always keep in mind that in every transaction we have to calculate interest. Okay. And always make a face value column. Okay. Don't put number of shares or any other column. Okay. In case of shares, instead of face value, we'll put number of shares. And instead of interest, we'll have dividend column. Okay. And after that, cost column. So again, we have here debit side and credit side. I hope all of you are already aware about this format. We'll start with the sum. So on 1st April 21, we have a balance. Okay. It says it holds rupees 1,20,000. So this is face value given to you of the balance investment on first day of the April. Okay. Then cost is given to you 1,17,600. 1,17,600. Okay. Now, as I told you, in every transaction you have to calculate interest. Now, interest rate is 6% already given to us. Okay. Face value is already given 1,20,000. So, what we need is time period for which you have to calculate interest. Okay. So, always remember you have to calculate interest from previous interest payment date till current transaction date. Now, since this is opening balance, it is on 1st April. So, before April, we must have received interest on 1st Jan, right? So, from 1st Jan till 1st April. Okay, how many months are there? Jan, Feb, and March. Don't count April because it's on 1st day of April. Okay, so for 3 months, you have to count interest, calculate interest. So, it will be like 1,20,000 into 6% into 3/12. Okay. So this way you have to calculate interest. We need 3 components. Face value mostly will be given in the sum. Interest rate will be given. Only thing is that you have to count period between 2 dates. Which 2 dates? Previous interest payment date and the transaction date. Okay. So please calculate this interest and put it here. I'll do it. 1,20,000 into 0.06, that's 6%, into 3/12. So into 3 divided by 12. That's it. We are getting 1,800 as our interest. Okay. So always remember, whenever a security is given with some percentage, then you have to calculate the interest in each transaction. Remember this. Okay. Okay. So let us proceed. So this one is done. Okay. You can put a tick mark. I can use pencil here. Next transaction is on 1st July. So 1st July is interest. See, this will remind you that now is the transaction for interest. Okay. So interest is your income. Okay. So whenever you will receive interest, what is the entry? bank to interest, isn't it? You are receiving money and credit the income, interest. Okay. So in interest column, you will write by bank. Huh? What is the date? 1st July 2021. Well, write 1st July 21. Okay. All right, by bank. Clear? Now calculate interest. How you will calculate? How much balance you have? 1,20,000, right? Into percentage 6% into how many months? Whenever you are calculating interest, not as a part of a transaction, but as on interest date. If two dates are given for interest, like in this sum, 1st Jan and July, then company is paying 6 monthly interest. So period will be into 6 by 12. Understood? If only one date is given, means company is paying annual interest. Okay? So don't consider months. Directly multiply with a percentage. Okay? So now calculate interest. I'll do it here. 1,20,000 into 0.06 into or directly divided by 12. So 3,600. I hope you understood this. Okay. Now look at the timeline. What next? Purchase on 1st August. So purchase. So whenever you buy investment, okay, investment comes in to investment to bank. So in investment account, you will write to bank. Okay. On 1st August 21. Okay. To bank. Okay. Now what is given? Let us read that purchase transaction on 1st August 21. Face value of 24,000. So face value given to you. In case they give number of shares, suppose they give 240 shares. So they must have already told you that face value is 100. So you can multiply and get the value. But whenever the symbol of rupees is there or rupees word is written, it means they have already provided you face value. So you can write the face value 24,000. Clear? Okay. At 102 come interest. What is come interest? See, whenever a price for any share or debenture is quoted, okay, it may include element of interest. Okay, suppose from last interest date, 3 months have passed, so I am eligible to get 3 months interest. Okay, if someone wants to buy my debentures, okay, after 3 months, more 3 months, he'll get interest for whole 6 months, isn't it? For first 3 months, I was the holder, but since I'm giving it to the new buyer, even that period of 3 months interest will be given to that person. So I may claim that interest from that person. I will add 3 months interest to that person. So I'll quote a price which will include that interest amount. So this is called as come interest price. Okay. So whenever come interest price is given, always remember first calculate interest here and then put cost value. Huh? Always remember whenever come interest is given, it means that cost value of 102 includes interest amount. Always remember whenever a quote is given come interest, first calculate interest. Okay, so let us calculate interest of this transaction. So what is the face value? 24,000. Always start with face value of that transaction into 6%. This will be given to you into how many months have lapsed from previous interest payment. The interest was paid on 1st July. So July, 1 month has lapsed. This is 1st August, so you can't count for this one. So into 1 by 12. Okay, that 6% is for a full year. Na? So out of that, only 1 month's interest we have to give here. Okay? So calculate interest. So whenever come interest is given, it means the price quoted is including interest. So we have to remove that interest from that price quoted. Okay, so always calculate interest first. So I calculate 24,000 into 0.06 into 1 divided by 12. Okay, so it's 120 rupees. Understand? Okay. Now the rate for this debenture was given as 102. So see, whenever you are given face value, you are given face value, and price is given as 102. So it means the value of share must have been or debenture must have been 100, isn't it? Okay. So instead of dividing 24,000 by 100 and getting 240 debentures and multiplying by 102, what best you can do is you directly calculate this as a percentage. That is 24,000. Whenever value is given, you can do this. Only then 24,000 into 102. 102%. Let me see if this is working on. This works on Calci. Let me see if it works on PC as it's working. Okay. On Calci also you can do it. 24,000 into 102%. Okay. Now, as I told you, this is including the interest. What is the interest amount? 120. So this 24,480 includes the interest of 120. So what I'll do, I'll remove 120 from this sum. Okay, always remember this. Whenever they give quote as come interest, first calculate interest and remove that interest amount from the price quoted. Okay, minus 120. Yes. Is this clear, students? I hope this is clear. Okay, so purchase done. Next is sale on 1st November. So it will be on credit side, 1st November, 2021. Whenever we sell investment, what is the entry? Money is coming in, bank account debit to investment. Okay, so bank is debit, right? And investment is credit. So in investment, we'll put on the credit side by bank. Okay, so we are selling investments post face value is 12,000. So I'll put here 12,000. The price quoted is come interest. So again, I have to first calculate interest. Okay, follow the normal procedure. How to calculate interest? Face value of investment sold is 12,000 into 6% into what is the time period which has lapsed since last interest payment. Last interest was paid on July. Just look at the above transaction. So from that now till now, July, August, September, October. Yeah, 4 months have lapsed, right? November is the on 1st November the transaction taken. So don't count November. So July, August, September, and October. 4 months have lapsed. So into 4 divided by 12. Okay, so I'll calculate the interest amount. 12,000 into 0.06 into 4 divided by 12. Amount is 240. Okay. Now here again, the price was quoted as come interest. Okay. So we always need X interest price in cost column. Okay. So again, I'll calculate the value and from that I'll remove 240. Understood? So how to do it? I just told you first take full face value into 104%, 104 percentage. Okay. So this will give you one value. This is including your interest. So what you will do from this will remove 240. Okay. I'll just put a bracket. Minus 240. Okay. 12240 is the net selling price for that investment. Clear, students? Okay. Now, since there is a sale, we have to calculate whether we have made a profit or loss on this sale transaction. Okay. What we need to do? We need to know what is the profit or loss we have incurred on this transaction. Okay. I'll show you how to calculate profit or loss. Just drink some water. Okay. So how to calculate profit or loss on sale? Okay. You begin with X interest selling price. Okay. Selling price. Simple. Whenever you want to know profit, selling price minus purchase price will give you profit or loss, right? So we start with X interest selling price. What is my selling price? 12240, right? Minus weighted average cost of investment. Okay. Now the formula is amount column debit minus credit upon face value column debit minus credit. Okay. Into face value sold. This is the formula. Very simple formula. Okay. For this, you need to add up all the amounts in the amount column or cost column, debit minus credit. Okay, we have to exclude this sale transaction. Okay, we have to exclude the figures which are appearing in this sale transaction. Okay, so add all the amounts. So 117,600 plus 24,360. So 141,960. 141,960. Okay, minus credit. There is no transaction on credit side except this sale. We need in face value and cost column. Ignore interest column. Okay, clear? Upon face value debit minus credit. Face value debit is 120 plus 24, 144,000. 144,000. Okay. Into face value sold. Face value sold is how much? 12,000. This way you will get the cost of the investment which is sold. Okay. Let me calculate 141,960 upon 1,44,000 into the bracket into 12,000, right? So my cost is 11830. So my selling price is higher than my cost price. So I have made a profit. Then calculate profit minus 118. So profit is 410. So it will appear on the debit side. If loss is there, it will on the credit side. Okay. So I'll put the date. 1st November. I'll copy this one. I'll write to P&L account. Okay. I'll write in cost column 410. I hope this is clear, students. Sale transaction. Okay. So next transaction after 1st November is purchase on 1st December. So purchase again on the debit side. I'll put 1st December 21 to bank. Okay. So let us see the details. Purchase on 1st December is face value is given 48,000. So I'll put 48,000. Okay. The quote is X interest. So we can directly write the amount. Okay. So 48,000 into 105%. You need not minus interest. So here you can relax, you can calculate interest later on. Okay. So now let us calculate the interest. As I told you, we have to calculate interest on every transaction, Okay. So value is 48,000 into 6% into how many months have lapsed from July. So July, August, September, October, November, December. December hasn't lapsed. So 5 months into 5 by 12. Okay. So I'll calculate the interest amount, 48,000 into 0.06 into pi by 12. Okay, 1200. I hope this is clear, students. Okay, I think we are running late. Okay, so I speed up. So can you solve the other transactions in same fashion? Again, record purchase and sale. Okay, so when you reach at the end, I'll show you what to do on the last day. Last day is 31st March 22. You write buy balance CD. Okay, you close the face value column. Okay, you'll get a balancing figure. Okay, then on that, okay, you have to calculate interest. Don't forget to calculate interest on that closing balance. Okay, as I told you, on every transaction, you have to calculate interest. Okay, so whatever amount you will get here in closing, say for example 1,50,000. So on that 6% into what is the last interest payment date? First Jan. So Jan, Feb, March, 3 months have left. So calculate 3% on that face value, put in interest column. Then close cost column, you'll get the balance. Okay. Sometimes market price is given in the sum. Okay. So just close in the same fashion, find out what is the balancing figure when you close the account. But don't write that value in the account, just write it somewhere else. Okay. Take for example, we got for 50,000 as our closing balance. Then they will provide you on market price. Okay. So on the closing balance, so for 150 is there. On this, apply that market price and see what value you are getting. Suppose you got 55,000. Then apply the accounting standard 2 formula, uh, cost or market price, whichever is less. So accordingly, you will post 50,000. Understood? So this way, in case market price of share is given, you can apply that formula following the conservatism concept and record the value. Okay. So I don't know. Let me see. Students are still there. Yeah. Okay. So couldn't tell me if you want me to teach you investment account of shares, or shall we go to buyback of shares? You can just post in live chat or just put it on the WhatsApp group. Okay. So no chats available. Journal entries I have just shown you. Okay. While solving, you just discuss the journal entries. Very simple entries. Okay. Whenever you buy investment, it will be 6% gold bond account debit to bank account. Okay, just like that only. Okay, no big deal in their entries. Mostly they will ask you to make an investment account. They won't ask you to pass entries in investment account. Okay. Uh, well, I'll take a 5 minutes break. Then we'll go for the last chapter, buyback of shares. Okay. It's 9:52, so we'll start exactly at 10 o'clock with buyback of shares. Okay. Thank you, students. Be here, be on the channel. Okay. We'll start in 7 to 8 minutes. Okay, students, so we'll start with now buyback of shares. Okay. No. So what is buyback? Buyback is buying back its own shares by the company. Okay. So with some conditions, uh, buyback is allowed. Okay, buyback by any company. Okay. Now I have made some equations here. You can see these are some conditions which a company needs to fulfill using this format. Okay. So as I told you, buyback of share means the company purchases its own equity shares. Okay. Now you must be remembering that in case of redemption of preference shares, we used to make equations. So in same fashion, we have to make equations in case of buyback of shares also. Okay. Suppose uh, you are buying back equity shares worth rupees 1 lakh. In that case, either you have to make a fresh issue of same amount, that is 1 lakh. So your buyback is 1 lakh and you are making a fresh issue of 1 lakh. Okay. Otherwise, what you can do is against buyback of 1 lakh equity shares, you can make a fresh issue of 50,000 shares. It can be of equity or preference, both are allowed, but you can't issue debenture as a fresh issue. Okay, and the remaining you can raised out of security premium and free reserves to create CRR, capital redemption reserve, to the extent of the balance required. That is 50,000. So this way, fresh issue and CRR should make up for the buyback amount. Okay, that's most important. Okay. Now there are few entries which you need to learn by heart. This entry won't change, only the amounts will change. Okay, when in the various sums, these entries won't change, only the amounts will change. So I suggest you that you learn these entries by heart. Okay. Uh, in some cases, uh, the shares given in the question are partly paid. Okay, like 10,000 equity shares of 100 each, rupees 80 paid. So that 20 rupees balance is to be called up from the public. Okay, so first condition is that you convert all partly paid equity shares into fully paid up. Okay, so you can uh, make a final call. The entry for a final call will be final call upon debit to equity share capital account. Clear? And when you will receive money, it will be bank account debit to final debit. Okay. Same way, you may make a fresh issue. Okay, whenever fresh issue is made, the entry will be bank account debit to equity share capital or preference share capital, whichever security you are issuing. Clear? Sometimes in the sum it may be given that the fresh issue is made in two parts. That is, we are calling some amount on application and remaining amount on allotment. In that case, your entry will be like first you will receive application money, bank account debit to equity or preferential application account. Then you will transfer this to share capital. So equity or preferential application to equity share capital or preferential capital. Okay. Then the allotment entry will be equity or preference share allotment account debit to equity share capital to security premium. In case premium is there, it has to be credited in this allotment entry. By default, discount or premium is to be charged or recovered in allotment entry. Then you will receive that allotment amount, bank to allotment amount. Clear? So fresh issue can be in two parts. Otherwise, normally one single entry will be there, like bank account debit to equity share capital account or preference share capital account. I hope this is clear. Okay. Now, uh, as I told you, we have to either create CRR or make a fresh issue. We just saw entries for fresh issue, bank to equity share capital or bank to preference share capital. Then we have to create CRR to the extent required to equate the face value of equity shares bought. Okay, so whatever amount is required, we'll raise through CRR by using divisible profits or free reserves. Okay, so whenever you have to create a CRR, always follow this order. First use security premium, then P&L account balance, then general reserve. If the question says that keep use P&L account to the least, then after security premium you can use general reserve and then you can use P&L. Okay, so whatever reserves you will be using will be debited and CRR will be credited. I hope this is clear. Okay, then the equity buyback will become due. That is equity share capital account debit to equity shareholder account. If we are paying more than face value, then there will be a loss. So premium on buyback will be debited. So entry will become equity share capital account debit, premium on buyback account debit to equity shareholder account. Okay. Then you will pay this amount to the equity shareholders. Equity shareholder account debit to bank account. Clear? And that POBB, premium on buyback, is a loss, and we have to write it off. While writing off, you can use security premium. If it is less, you can use P&L and general risk. So whatever reserves you use will be debited to premium on buyback. Is this clear, student? These are basic entries. Okay, but additional conditions are there in case of equity buyback. Okay, sometimes the question may not state how many equity shares are to be bought back. Okay, so in that case, we have to find out the value of, or rather, find out the maximum amount of buyback which a company can make. Okay, so for that, these conditions are required. Okay, so first condition is that is a source of buyback is 100% of free reserve plus security premium. So you can add all the reserves, okay, into the security premium, but don't take CRR already created. Okay, so you have to leave that alone because it was raised last time before the current buyback. Okay, so don't use that CRR. Okay, we can use the rest of the reserves, including security premium. Okay, so that would be one figure. Okay, 100% of reserves. That would be first figure. Second, you have to calculate 25% of own fund. Okay, so what is own fund? All share capital plus reserves, isn't it? So reserves will be what you included in first amount. Okay, in working out one above. Okay, so take all those reserves plus equity capital plus preference share capital. Okay, you will get the total amount. You will get the total amount. Total own fund you will get. Okay, of that amount you have to calculate 25%. So that will be your second figure. First figure was 100% of reserves. Okay. Second is 25% of own fund. Own fund includes equity capital, preference capital plus all the reserves mentioned in working note 1. Clear? Then third amount you have to calculate is it relates to debt equity ratio. That is after buyback, your debt equity ratio should not go below 2:1. Okay. Okay. So for that, you can use this simple formula: own fund minus half of debt fund or borrowed fund. Okay. So own fund we have already calculated in working note 2. So you take that figure minus half of borrowed fund. The borrowed fund will include debentures, bank loan. Okay. So all long-term loans except current liabilities. Huh? Okay. So this will give you third amount. So you can buy back maximum of least of these three. So 1, 2, 3, these three figures will be there. So least of this amount will be the maximum amount of buyback which a company can make. Is this clear, students? Okay. Now in question, sometimes they will give you offer price and sometimes they may not give you offer price. Offer price means the price at which company is going to buy back its shares. Okay. So in case offer price is given, very simple, you can find out maximum number of shares which can be bought back. Okay. So first take the least amount of 1 to 3. Okay. So least amount of 1 to 3 divided by offer price. You will get the number of shares to be bought back. So once you get number of shares to be bought back, you can go ahead with the solution as if it's a normal sum. Understood? So whenever price is given, calculate about 3 figures, take list of them, divide by offer price. You will get the number of shares, and then you can proceed with the as if it's a normal sum. Okay, clear? Sometimes they may not give you offer price. Okay, actually this is not logical. When offer price is not given, the answer may be weird, but still it's there in your syllabus. You have to study. Okay, so in case offer price is not given, okay, we have to find the offer price. That's it, nothing else. But that will not be a logical offer price. It will be a random price, or we should say rather a maximum offer price, which can be offered to the shareholder. But the directors will have to think over it before offering such a price. Okay. So again, in this, we have already calculated list of the above 3. Okay. So take that upon there is a limit of number of equity shares which can be bought back. It is 25%. So you cannot at a time buy back more than 25% of equity shares. So list of 1 to 3 divide by 25% of equity shares. Number of equity shares, don't take capital. Divide by number of equity shares. You will get the offer price. Okay, then you can again use the formula number 4 or working note number 4 to get the number of shares. It will be same only. Okay, so don't worry. So this way you have to first do the calculation, find out number of shares to be bought back. Okay. Why we need offer price? Well, suppose your face value of your share is 10 and the offer price is 30, then there is a premium of 20 rupees, premium on buyback. We have to make equations based on that. Okay. So you always need a offer price. Okay. So if it's given, well and good, you calculate the number of shares and you proceed with the sum. Otherwise, you calculate the maximum offer price which can be offered, then calculate number of shares. It will be same 25% of equity capital, and you proceed with the sum. Okay. So this way you can solve the sum. Let me see how many of you are there now in the meeting. So accordingly, I will continue. Okay. So we'll stop here, students. All the best to you. Less than 10 students are there. So I'll wind up my lecture here. I hope you have understood whatever I have taught you. All the best to you. Do attempt all the questions. Choose the easier question and go ahead with it. Okay. You'll always have an option. Okay, with the other chapter. Okay. Attempt the final account question at the end. Never start with that chapter. You can take up investment accounting or internal reconstruction first. Okay, then go for buyback, and at the end, if time permits, if no other option is there, you can go for final. Okay, so that's it for today. Thank you so much. If you need costing revision lecture, do let me know on your WhatsApp. You can message me. I'll keep on lecture tomorrow. Okay, thank you. Bye. See you. Take care.